Hi, this is Anthony Parent of Parent and Parent LLP of Stamford, Connecticut. And in this video, I want to talk about what you should do if you have unfiled taxes for the past 10 or 15 or even more years. You know, the IRS only gives you a limited amount of time if you owe money to claim it back. They only give you 3 years from the tax return was originally due, or 2 years since the date you last paid. Now, on the other side, the IRS has rules that favor them. If you never file a tax return, the IRS has forever to assess taxes against you. So there's one reason why you should file your taxes, but you probably already know you should. So what's probably holding you back is fear. Now let's assume the worst situation. Let's assume the worst case, that you are facing some criminal exposure and you're worried about coming clean. Well, the IRS has a program that allows people to come clean with their tax problem as long as a criminal investigation hasn't started. And typically you'll know when you're under investigation. But if a criminal investigation has not started and you promise that you're going to abide by the terms of the disclosure, you can come clean with the IRS and not have to worry about any criminal charges. Now, what kind of people would want to use a voluntary disclosure? Well, people who have a high income, and because the law really goes after people with higher income a little bit different, and then people with offshore accounts, unreported offshore accounts. Those are the two types of people that would want to use a voluntary disclosure, and the precise procedures on each one is slightly different. Now, the offshore disclosure might be overkill for some people. So for a lot of times, filing your old returns is simply getting your records together and putting it together. The IRS usually only requires that you go back 6 years, and that they'll usually not look to go back much more than that, because they simply don't have the resources to find these documents and assess the taxes. But 6 years is typically good enough. But one of the problems we have is the IRS does something. If you don't file a return, and because reporting has gotten so much better, they're able to do something called a substitute for return, or substitute filed return, SFR as we call it in the business. So the problem with this is that these go way, 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 way back. So what are your options then? Well, you can do something that's called an audit reconsideration. You file a return as it should have been done in order to reduce your liability. But what if you can't find anything? There are ways we're able to use. Sometimes we're able to use statistical models to show expenses in order to reduce debts. But even in cases where we're totally out of luck, we're even able to lower a tax bill off of an SFR simply by showing a lower ability to pay. This is Anthony Parent of Parent and Parent LLP, the IRS Medic. I hope you found this video informative. If so, please like it. Please subscribe to this channel. Follow us on Facebook and Twitter. And please go to taxattorney-stanfordct.com. Thanks for watching.